Before we begin, please note that I am not a licensed financial advisor or insurance professional. The information provided in this video is for educational and informational purposes only and does not constitute financial or legal advice. You should always consult with a qualified and licensed professional before making any decisions about your insurance coverage. This presentation is based on the insurance landscape within the United States, and regulations can vary significantly by state. There's a 90% chance you are currently being ripped off by your insurance company. I'm not saying that for shock value. I'm saying it because of a single, powerful, and deeply misunderstood word: bundle. That word, plastered on every commercial, every website, every piece of mail from every insurance company in America, is not the key to saving money. It is the key to their profit. It's a magic trick, an illusion of simplicity designed to do one thing: get you to stop paying attention. And it's working. It's costing the average American family over $600 a year in hidden fees, creeping rate hikes, and coverage gaps they don't even know they have. $600. What could you do with that money right now? That's a car payment, a vacation flight. That's your entire grocery bill for a month or two. It's real money, and it's being siphoned directly from your bank account under the guise of a deal. This video is going to change that. For good. We are going to pull back the curtain on the entire home and auto insurance bundle industry. I'm not just going to give you a few tips. I'm going to give you the entire playbook. You will learn why your loyalty is punished, not rewarded. You will understand the fundamental difference between the two types of bundles, one that actually saves you money and one that's a trap. And most importantly, you will learn the exact questions to ask and the precise actions to take to cut your bill by 10, 20, or even 30% without sacrificing a single drop of coverage. By the end of this, you won't just be a consumer. You'll be an expert. You will see the matrix. Let's start with a simple story about two neighbors, Sarah and Mark. They live on the same street, in nearly identical houses, and drive similar cars. Both are safe drivers with good credit. A few years ago, they both switched to the same big-name insurance company, attracted by a flashy commercial promising huge savings if they bundle home and auto. Sarah went online. She saw the big, friendly button, bundle and save 25%. She clicked it, entered her info, got a quote that was cheaper than her old provider, and signed up. Easy. She got her discount, set up autopay, and didn't think about it again. She was busy. She trusted the system. She got the deal. Or so she thought. Mark did something different. He understood a core principle the insurance companies spend billions of dollars to make you forget. Insurance is not a product you buy, it's a contract you negotiate. And the bundle is the most confusing, and therefore most profitable part of that contract. So what happened? The first year, Sarah and Mark paid almost the same amount. The bundle discount was real. But then came the first renewal. Sarah's total bill went up by 8%. Not a huge jump. She got the email, glanced at the number and figured, inflation, I guess. She did nothing. The second year, it went up another 12%. Now she's starting to get annoyed. She's had no accidents, no tickets, no claims on her home. Why is she being punished? She calls customer service, and a polite but firm representative gives her a vague answer about rising costs in your area and new risk assessments. It's a script. It's designed to make her feel powerless, to make her give up and just pay the bill. And she does. Meanwhile, Mark's bill barely budged. Year 1, it went up 1%. Year 2, he actually got it to go down. What did Mark know that Sarah didn't? He knew that there isn't just one type of insurance bundle. There are two, and the one Sarah has, the one that 90% of Americans have, is what I call the stapled bundle. Imagine you have two separate policies, one for your car and one for your house. They are written separately, they have separate policy numbers, they are, for all intents and purposes, two different products. The insurance company simply takes these two policies and, like a piece of paper, staples them together and writes 15% off on the front with a magic marker. That's the stapled bundle. It's a marketing discount. Coupon. And just like any coupon, it's designed to get you in the door. It is not designed for your long-term benefit. The problem with the stapled bundle is that it creates the illusion of a single, unified product when it's not. The auto side of the company and the home side are often two completely different beasts. They might even be underwritten by two totally different subsidiary companies. They have different goals, different risk pools, and different algorithms for setting rates. So when your auto insurance rate needs to go up because of their internal metrics, it goes up. When your home insurance rate needs to go up because a storm happened 3 states away, it goes up. The staple does nothing to stop this. In fact, it makes it worse. Because you think you're getting a bundle deal, you're less likely to shop around. You're less likely to question the individual increases. You've been psychologically conditioned to believe you're already getting the best price possible. This is called the loyalty penalty, and it is the bread and butter of the modern insurance industry. They count on you like Sarah being too busy or too intimidated to look closer. They give you a small discount with one hand and then slowly year after year take back much more with the other. Now let's look at what Mark has. Mark has what's called a true bundle, or an integrated policy. This is fundamentally different. This isn't two policies stapled together. It's often a single policy contract, issued by one underwriter, that covers both your home and your auto. It has one policy number. The key difference isn't just administrative. It changes the entire financial and legal structure of your coverage. For example, a true bundle might offer a single deductible. Imagine a tree falls in your driveway, crushing the hood of your car and damaging your garage. With Sarah's stapled bundle, that's two separate claims. She has to pay her home deductible, let's say $1,000, and she has to pay her auto deductible another $500. That's $1,500 out of her pocket. With Mark's true bundle, because it was one event, he only pays one deductible, the higher of the two. He pays his $1,000 home deductible, and both his car and his garage are repaired. He just saved $500 instantly. These true bundles are rarer. They're not always advertised as loudly because they can be more complex, and sometimes require a more sophisticated agent to write them correctly. They aren't offered by every company, but they often provide more stability in rates and more comprehensive protection. They treat you like a single valued client, not two separate profit opportunities. So, the first, most critical step in taking back control of your insurance costs is to figure out which one you have. Is your bundle just a marketing staple? A coupon designed to make you complacent while your rates climb? Or is it a truly integrated policy designed for comprehensive protection? How can you tell? It's easier than you think. You don't have to be an expert. You just have to look for one or two key phrases in your policy documents. And in a few minutes, I'm going to tell you exactly what those phrases are. This is the foundational secret. This is the difference between Sarah, who is frustrated and overpaying, and Mark, who is confident and in control. It's not about being an insurance genius. It's about understanding the game. The game is rigged to look simple, to make you click the big, friendly bundle button and forget about it. But today you stop playing their game. Today you learn the rules and you start playing your own. Because the difference between a stapled bundle and a true bundle isn't just a few words on a piece of paper. It's the difference between being a victim of the system and being the master of it. Stick with me because we're just getting started. So let's start with the most common type of bundle, the one you see advertised during every single football game. It's the one your friendly neighborhood agent probably pushed on you with a big smile. I call it the stapled bundle, and it's built on a foundation of pure marketing genius and a little bit of deception. Imagine you walk into a hardware store. You need a hammer and some nails. The store has a big sign. Ultimate Tool Bundle. Get our world-famous hammer and a box of premium nails for one low price. Sounds perfect. You pay at one register, you get one receipt, and you walk out with what you believe is a single cohesive product from one trusted brand. But here's what you don't see. The hardware store doesn't actually make the nails. They can't. The machinery is too expensive, the metal is too hard to source, they're just not in the nail business. So they made a deal with a completely separate company, Nailco, a brand you've never heard of, to supply the nails. The hardware store just slaps their own sticker on the box, staples the two products together at the checkout counter, and calls it a bundle. You get home, you use the hammer, it's great. Feels solid. It's everything the brand promised. Then you open the box of nails. They're flimsy. The heads snap off. They bend the second they touch a piece of hardwood. You try to take them back to the hardware store, and the cashier looks at you with a blank stare. Sorry, he says. We don't handle nail complaints. You have to call the 1-800 number for Nailco on the side of the box. That, in a nutshell, is the stapled bundle. The vast majority of insurance bundles in America work exactly like this. A massive, well-known auto insurance company, one of the ones with the funny commercials and the catchy jingles, spends billions of dollars to convince you they're your one-stop shop for protection. They want to be the trusted hardware store for your life. The problem is, most of these giants are experts at one thing: insuring things with wheels. Cars, motorcycles, RVs. That's their hammer. It's what they built their empire on. Homeowners insurance? That's a completely different beast. It's the nails. Insuring a home means dealing with risks like hurricanes in Florida, wildfires in California, tornadoes in Oklahoma, and frozen pipes in Minnesota. It is an incredibly complex, localized, and high-stakes game. Many of the big auto insurers decided long ago that they don't have the appetite for that kind of risk. It's just not their business. But they still want your money. They know that if they can sell you a home policy, you're much less likely to ever leave them for a competitor. You become a sticky customer. So what do? They create a stapled bundle. They partner with a separate, often much smaller, and sometimes lower-rated home insurance company. This is their nailco. This partner company is called an underwriter. They are the ones who actually create the home insurance policy. They are the ones who set the prices, and most importantly, they are the ones who will pay or not pay your claim. Your big, famous auto insurer simply acts as the storefront. They are the marketing department. They put their logo on the bill. They give you a multi-policy discount to make it look like a cohesive deal. And they funnel your home insurance premiums directly to their hidden partner. You have one bill, one app, one agent. Feels simple. Feels integrated. But it is an illusion. You don't have one insurance company. You have two. And you often won't realize this until the absolute worst moment. Right after a disaster. Let's say a massive storm rolls through your town. A huge oak tree in your front yard is uprooted and crashes down onto your garage, crushing your new SUV parked inside. It's a nightmare scenario. But you think, okay, deep breaths. This is why I have the bundle. One call, one claim, one deductible. So you call the 1-800 number you have saved in your phone. You get a friendly agent from your big-name auto insurer. You explain what happened. No problem, the agent says. Let's get your auto claim started for the SUV. An adjuster will be in touch within 24 hours. You feel a wave of relief. Then you say, and what about the garage? It's completely destroyed. And that's when you hear the words that make your stomach drop. Oh, the agent says. For the damage to the garage itself, you'll actually need to file a separate claim. Let me transfer you. Suddenly you're on hold listening to terrible music. A new voice comes on the line. They don't work for the company you thought you were insured with. They work for a company you've never heard of, American Standard Home Protection, or Midwest Dwelling Assurance. This is Nailco. You have to explain the entire story all over again. They have a different claim number, a different process, a different set of rules. Now, instead of one simple process, you are fighting a war on two fronts. You have two separate claims adjusters who may not even talk to each other. The auto adjuster might come out the next day, assess your crushed SUV, and cut you a check quickly. They're efficient because that's the business they're in. But the home adjuster from the partner company, they might take a week to show up. They might argue about the cost to rebuild the garage. They might claim the tree was rotted and therefore it's a maintenance issue, not a storm issue. You're now in a bureaucratic nightmare, bouncing back and forth between two entirely different companies with two entirely different motives. And here's the cruelest twist of the stapled bundle: the deductibles. You assumed you'd pay one deductible for one event, but you didn't have one event. According to the fine print you never read, you had two separate losses with two separate companies. So you have to pay your $1,000 auto deductible to get your car fixed. And you have to pay your separate, often much higher $2,500 home deductible to get your garage rebuilt. That single storm just cost you $3,500 out of pocket before you see a dime from insurance. All that bundle discount you were so proud of? It just evaporated in an instant and then some. This is the fundamental weakness of the staple. It's not a marriage. It's just two companies sharing a mailing address. There is no shared risk. There is no shared commitment to you, the customer. The loyalty you've built up over 10 years of perfect driving with your auto insurer means absolutely nothing to the home insurance underwriter, who sees you as nothing more than a policy number and a potential loss. If that home claim is big enough, the partner company can simply choose not to renew your policy next year. They can drop you like a hot rock. And when they do, you don't just lose your home insurance. You lose your bundle, which means the discount on your auto insurance also vanishes overnight, and your car insurance premium can suddenly spike by 20 or 30%. Even though you did nothing wrong, you are left scrambling to find a new home insurer, now with a major claim on your record, making you look like a high-risk customer to every other company. The staple bundle sells you the dream of simplicity and savings, but in your moment of greatest need, it delivers complexity and cost. It's designed to be easy to buy, not easy to use. It prioritizes the company's ability to acquire customers over its duty to serve them. It's a product built for the boardroom, not for your kitchen table after a fire. But what if there was a different way? What if the hammer and the nails were forged in the same factory, by the same company, designed to work together from the very beginning? What if the company selling you the policy was the exact same company that would handle your claim? For both your car and your home, under one roof with one team and one shared goal. To make you whole again. That is the promise of a true bundle. And it's not just a marketing term. It's a completely different corporate and financial structure. It's the difference between a loose affiliation and a unified fortress. And understanding how to find one, and what it really means for your financial security, is the secret the big advertisers hope you never ever learn. So let's pull back the curtain on that secret. The insurance world is built on two fundamentally different models that are both sold to you under the exact same name. A bundle. On the surface, they look identical. They both promise savings. They both promise convenience. But underneath, one is a house of cards, and the other is a reinforced vault. First, let's talk about the fortress. This is what we'll call the true bundle. A true bundle comes from a single unified insurance company. Think of the big names you see advertising during the Super Bowl, the ones that have been around for a century. When you buy a true bundle from one of these companies, you are entering into a direct relationship with one entity. That single company is the one that underwrites both your home policy and your auto policy. Now that word, underwrite, is critical. It's a $10 word for a simple concept. It means they are the ones assuming the financial risk. They are the ones who calculate your premium, they are the ones who set the terms of your coverage, and most importantly, they are the ones who will write the check when you have a claim. With a true bundle, the same company, the same financial entity, is on the hook for your car and your house. They have a complete 360-degree view of you as a customer. They see all your data, all your history, all your risk, all under one roof. This is the unified fortress. Now for the other model, the house of cards. We'll call this the broker bundle, or the agency bundle. This is what you often find when you use those online insurance comparison websites that promise to shop dozens of carriers for you in seconds. It's also what many independent insurance agents sell. On the surface, it feels the same. You talk to one person or use one website, and you walk away with a home and auto policy, and you get a bundle discount. But here's the illusion. You aren't buying insurance from one company. You are buying two separate policies from two completely different insurance carriers. The website or the agent is just the middleman, the matchmaker. They've placed your auto insurance with Company A because they offered the best rate for your driving record. And they've placed your home insurance with Company B because they gave the best rate for your neighborhood. The bundle is just a marketing wrapper. The discount might come from the agent's commission or small agreements between the carriers, but the core reality is this. Company A has no financial relationship with Company B. They don't share data. They don't coordinate claims. They are two separate, competing corporations that now happen to have you as a customer. This is the loose affiliation. So what? Why does this matter? You saved money, right? Who cares if the checks are signed by different company logos? This distinction means absolutely nothing, until the day it means everything. Let's imagine a scenario. Let's call our homeowner Mike. Mike lives in a part of the country that gets severe weather. A massive hailstorm rolls through his town one afternoon. The hail is the size of golf balls. It pummels his neighborhood. When the storm passes, Mike walks outside to a scene of devastation. His car, which was parked in the driveway, has a shattered windshield and is covered in dents. His roof looks like it's been hit with 1,000 hammers, with shingles cracked and granules stripped away. Mike is stressed, but he's also relieved. He thinks, thank God I have insurance. And I have that great bundle I got online. One call and I'll get this all sorted out. So Mike makes the call. He's routed to a claim center. He explains what happened. The hail damaged both his car and his roof. The person on the other end is very polite and says, okay, I can definitely help you with your auto claim. Let's get that started. They go through the process, get the details, and set up an appointment for an auto adjuster to come out. At the end of the call, Mike says, great, so what about the roof? And then comes the sentence that changes everything. The representative says, oh, for your home policy, you'll need to call a different number. That policy is with a different company. Suddenly, Mike's feeling of relief evaporates. He's not making one call. He's making two. He's not dealing with one company. He's dealing with two. He now has to start the entire process over again with a completely different company, a different claims adjuster, a different set of procedures, and a different timeline. But it gets worse. The auto adjuster from Company A comes out on Tuesday. He assesses the car and declares it a total loss. He says they'll cut a check, but it'll take a week or two to process. The home adjuster from Company B can't come out until Friday. He gets on the roof, agrees it needs a full replacement, but says they're swamped with claims from the storm. It could be a month before a roofing crew they approve can even start the work. Meanwhile, a new storm is forecast for next week. Mike's roof is compromised. He needs his car to get to work. Company A won't pay out until they get the title, but Mike can't get a new car until he has the check. Company B is telling him to just put a tarp on the roof, but the roofer they sent him to says a tarp won't hold up in high winds. Mike is now the unpaid, full-time project manager for his own disaster. He's on the phone for hours every day, trying to coordinate between two massive bureaucratic corporations that have zero incentive to talk to each other. Company A doesn't care about his roof, and Company B doesn't care about his car. And here's the knockout punch. Mike has to pay two separate deductibles, $1,000 for his auto claim, and another $2,000 for his home claim. That $3,000 completely wipes out the $400 he saved on his bundle for the entire year. Now let's rewind. Imagine Mike had a true bundle from a single unified company. He makes one call. The claims representative on the phone sees both of his policies on one screen. They open a single claim event, linked to both the home and the auto policy. They might assign a single adjuster to handle both, or at the very least a coordinated team that works together. They understand that the car and the roof were damaged by the same event. And many of these true bundle companies offer a single deductible benefit. In a situation like this, where one event causes a loss to both home and auto, you only pay one deductible, usually the higher of the two. Mike would have instantly saved $1,000. The entire process is streamlined. The company has a holistic view of his situation and is structured to handle it efficiently. They're not just processing two separate claims. They're managing a customer's crisis. That is the profound structural difference. The broker bundle is optimized for the sale. It's designed to find the lowest possible price on the front end by mixing and matching different companies. It treats insurance like a commodity, like buying bananas from one store and milk from another, because the prices are a few cents different. The true bundle is optimized for the claim. It's built on the principle of integrated risk management. The company is making a long-term bet on you as a whole customer, not just on your car or your house. The discount they give you isn't just a marketing gimmick. It's a reflection of a deeper financial reality. Because they have all of your data, how you drive, where you live, what kind of house you have, they can model your total risk with far greater accuracy. This allows them to price your policies more effectively and manage claims more efficiently. It's a structurally sounder, more coherent system from top to bottom. So when you're shopping for a bundle, the most important question you can ask isn't, how much will I save? It's, will both my policies be underwritten by the same single company? If the answer is no, you don't have a fortress. You have a loose affiliation held together by marketing tape. And you're one bad day away from discovering just how fragile that tape really is. The two systems aren't just different in how they handle claims, though. They're fundamentally different in how they calculate your price in the first place. The way a unified company leverages its vast pool of data to create a price for a true bundle is one of the most misunderstood and powerful forces in the entire insurance industry. It's how they can sometimes offer a price that seems almost impossibly low, while the broker bundle struggles to keep up. Understanding this pricing alchemy is the next step to becoming a truly savvy insurance consumer. So let's dissect that alchemy. To understand how a captive agent can offer a bundle that seems to defy financial gravity, you don't need to look at an insurance textbook. You need to look at your local grocery store. Think about the last time you went to a big box store like Costco or Sam's Club. What's one of the first things you see, or at least smell? That $5 rotisserie chicken. Or think about the gallon of milk at the back of the supermarket, priced so low it barely seems possible. These are what's known in the business world as loss leaders. A loss leader is a product sold at or below its actual cost to produce. The store isn't making money on that chicken. In fact, they're probably losing a little bit on every single one they sell. So why do they do it? It's brilliant, really. They do it because they know you're not just walking in, grabbing that chicken, and walking out. The chicken is the bait. Its purpose is to get you in the door. Once you're inside, you're going to walk past the 60-inch televisions, the $1,000 patio sets, the bulk packages of paper towels, and the case of wine. They lose $1 on the chicken to make $50 on the rest of your cart. In the world of the captive agent bundle, the auto insurance is very often the rotisserie chicken. It's the aggressively priced, heavily advertised product designed to get you in the door. A major national carrier might spend billions on commercials featuring quirky characters and catchy jingles, all screaming about how much you can save on your car insurance. They are willing to break even, or even take a small, calculated loss on your auto policy, because they aren't just selling you auto insurance. They're selling you a relationship. They're selling you a bundle. And the real prize, the high-margin product they want you to put in your cart, is your home insurance. Home insurance is what industry insiders call a sticky product. Think about it. How often do you really shop around for your home insurance? For most Americans, the answer is almost never. You get it when you buy the house because your mortgage lender requires it, and then you just keep paying the bill that gets sent to your escrow account. It's a set-it-and-forget-it purchase. Auto insurance, on the other hand, is not sticky. It's fluid. People shop for car insurance all the time. They get a new car, their kid starts driving, they see a commercial, they get a renewal notice with a price hike, and they immediately think, I wonder if I can get a better deal elsewhere. It's a much more volatile and price-sensitive market. The captive insurance company understands this human behavior perfectly. They know that if they can lure you in with an unbeatable price on your highly shopped auto insurance, they have a golden opportunity to sell you their much stickier and much more profitable home insurance policy. This is a concept called cross-subsidization. They are using the profits from one product line to subsidize the price of another. Let's put some simple, hypothetical numbers on it. Let's say, based on your risk profile, the true cost to insure your car for a year is $1,000, and the true cost to insure your home is $1,200. A broker, shopping at different companies, might find you a policy for your car at $1,000 and one for your home at $1,200, for a total of $2,200. The captive agent, however, plays a different game. They might look at your profile and say, okay, we'll offer him the auto insurance for just $800. That's a $200 discount from the true cost. They are willingly losing $200 on you. But then they'll say, and if you bundle with us, we'll give you a great deal on your home insurance for $1,400. Now you look at that. You see the $800 auto policy and think, wow, that's a fantastic price. The $1,400 for the home insurance might seem a little high, but you're so focused on that huge auto savings and the total is still $2,200, the same as the broker. Plus it's all in one place. Seems like a great deal, so you take it. But here's what happened behind the curtain. The insurance company took a $200 loss on your auto policy, but they made a $200 profit over the true cost on your home policy. The net result for them is zero. They broke even, but they've accomplished their primary mission. They have captured you as a customer. They have sold you the sticky product. And this is where the long-term strategy comes into play. They are betting on customer inertia. They know you're unlikely to shop for home insurance next year. So when your renewal comes up, they might raise your auto insurance by a modest 2%, but they might raise your home insurance by 5 or 6%. It's a small enough increase that it probably won't trigger an alarm bell, especially since it's often paid through an escrow account you don't look at every day. Over 5 or 10 years, these small incremental increases, primarily on the less volatile home policy, can transform that amazing bundle deal you got on day one into a significantly overpriced policy. The rotisserie chicken that got you in the door is still a good deal, but you've been paying a premium on everything else in your cart for years without even realizing it. This entire strategy is powered by one massive, overwhelming advantage that a captive insurer has: a unified pool of data. A company like State Farm or Allstate has millions and millions of customers. They have decades of data on exactly what their ideal, most profitable customer looks like. They know the exact credit score, the precise zip code, the type of car, the age of the roof on the house that results in the lowest number of claims and the highest profit. Their entire business model, their underwriting rules, and their pricing algorithms are laser-focused on attracting and retaining that one specific type of customer. They are not trying to be the best insurance company for everyone in America. They are trying to be the absolute, undisputed, best-priced insurance company for, say, a 45-year-old married couple with 2 cars, excellent credit, a 15-year-old home with a new roof in a safe suburban neighborhood, and no speeding tickets. If you fit that perfect mold, their pricing can seem miraculous. They want you, and they have precisely calibrated their loss leader strategy to get you. But if you fall outside that narrow profile, if you have a speeding ticket, or your credit isn't perfect, or you live in an area they deem higher risk, their price can be wildly uncompetitive. They don't want you, and their pricing is designed to politely, but firmly show you the door. This is why for some people a captive agent is thousands of dollars cheaper, and for their next-door neighbor they're thousands of dollars more expensive. It's not random. It's a calculated business strategy built on specialization and a deep understanding of their own data. So the captive agent bundle isn't just a simple discount. It's a sophisticated financial instrument. It's a carefully balanced equation of loss leaders, sticky products, cross-subsidization, and a long-term strategy built on customer inertia and hyper-specialized data modeling. It's an incredibly efficient system for attracting and keeping the most profitable customers. It seems almost unbeatable, but the broker bundle has a secret weapon of its own, a completely different philosophy of how to build the perfect insurance shield. And that weapon is choice. To understand the broker bundle, you have to fundamentally shift your thinking. The captive bundle, the one pushed by the big-name brands, is like going to the company store. You can buy anything you want, as long as it's made by that one company. The store is clean, the branding is reassuring, and they give you a 10% discount if you buy both their shoes and their shirts. The problem is, their shoes might be fantastic, but their shirts are ill-fitting and overpriced. You're forced into a compromise. The independent broker is not the company store. The broker is your personal shopper. They don't work for a single brand. They have a master key that unlocks the inventory of dozens of different brands, the big national players, the smaller regional specialists, the niche companies you've never even heard of. They don't care if you buy the shoes from Nike, the shirt from a boutique designer, and the pants from Levi's. Their only job is to put together the perfect outfit for you. The one that fits best, looks best, and provides the best value. This is the philosophy of the broker bundle. It's not really a bundle in the traditional sense. It's a custom-built portfolio. It deconstructs the entire idea that one company can be the best at everything for everyone. Let's be honest, that's a marketing fantasy. The insurance company that excels at writing policies for 16-year-old drivers in a souped-up Mustang is almost certainly not the same company that excels at insuring a historic home with a slate roof and original stained glass windows. These are wildly different risks, requiring different underwriting expertise, different pricing models, and different claims processes. The captive agent is forced to pretend they're the best at both. They'll jam that square peg of a high-risk driver into the round hole of their standard auto policy, and the price will reflect that awkward fit. It'll be astronomical. The broker, on the other hand, embraces specialization. They have the freedom to say, okay, for your auto insurance with your specific driving record and vehicle, Company X is the undisputed champion. Their rates are 30% lower than anyone else for your profile. But for your unique home, Company Y is the master. They understand historic properties, they won't penalize you for it. And their coverage for things like guaranteed replacement cost is second to none. So the broker doesn't bundle them. They place them separately. You get the best auto policy from the auto specialist, and the best home policy from the home specialist. And here is the mind-bending part. Very often, the combined total of those two separate, superior policies is less than the discounted price of the single, compromised bundle from the captive carrier. You get better coverage for less money. The so-called bundle discount was an illusion. It wasn't a reward for your loyalty. It was the price of your compromise. It was the little bit of sugar they gave you to make the medicine of their overpriced, ill-fitting secondary policy go down. Let's make this real. Imagine a family, the Jacksons. They live in coastal Florida. They have a home, 2 cars, and a 16-year-old son, Leo, who just got his license. They also have a small boat they use on the weekends. They go to a big, well-known captive insurance company. Let's call them NationSafe. The NationSafe agent is friendly and professional. He runs the numbers. The home insurance quote comes back and it's high. Very high. There's a massive hurricane deductible, maybe 5% of the home's value, meaning a $20,000 out-of-pocket expense before insurance pays a dime. Then he runs the auto insurance. When he adds Leo, the premium explodes. It more than doubles. The agent, trying to be helpful, says, well, let's bundle them together. If you take our home, auto, and I can even add a policy for your boat, I can get you a 15% multi-policy discount. The Jacksons look at the final number. Even with the 15% discount, it's a breathtakingly large figure. They're paying a fortune for a home policy with a terrifying deductible and an auto policy that penalizes them brutally for having a teenage son. They feel trapped. This is the only option the NationSafe agent can offer. He literally, contractually, cannot show them a quote from any other company. His hands are tied. Frustrated, the Jacksons visit an independent broker. The broker listens to their story, asks a lot of questions, and then gets to work. An hour later, she comes back with a completely different strategy. She says, "Okay, NationSafe is terrible for coastal homes right now. Their hurricane exposure is too high, so they're jacking up rates to scare away new business. But I have a carrier. Let's call them Coastal Fortress Insurance, a Florida-based specialist. They only insure homes here. They understand the building codes, the wind mitigation, and their rates are aggressive. We can get you a policy with them that has a much more manageable 2% deductible, saving you thousands if a storm hits. The premium is 25% less than NationSafe's quote." Then she moves to the auto. Now for your cars, Coastal Fortress isn't the right fit. But another company, Main Street Mutual, has the most forgiving rates for families with new drivers in this state. By placing your auto policy with them, we can cut that premium by nearly 40% compared to what NationSafe quoted you. And the boat? There's a third company that specializes in marine insurance. We can get a standalone policy for the boat that has better liability and equipment coverage for half the price. The Jacksons are stunned. They have 3 separate policies with 3 separate companies. They didn't get a single bundle discount. But the total combined cost of their 3 specialized policies is thousands of dollars less per year than the single discounted bundle from NationSafe. And the coverage is objectively better at every level. A lower hurricane deductible, better auto rates, and superior boat coverage. The broker didn't sell them a product. She solved their problem. She assembled a team of specialists, each perfectly suited for one piece of their financial puzzle. That is the power of the broker bundle. It's not about a single superficial discount. It's about deep structural savings achieved through strategic placement. The obvious question then becomes, isn't that a huge hassle? Managing 3 different companies, 3 different payments, 3 different renewal dates? And this is the broker's trump card. The broker is your single point of contact. You don't call Coastal Fortress or Main Street Mutual. You call your broker. If you have a claim, you call your broker, and she helps you navigate the process. If you have a billing question, you call your broker. When it's time for renewal, the broker is the one who automatically reshops your policies across the market to make sure you're still getting the best deal. They do the work for you. You get the benefit of a diversified, specialist-driven portfolio with the convenience of a single, dedicated advisor. The broker's loyalty isn't to a company. It's to you, the client. Their entire business model is predicated on their ability to save you money and provide you with better coverage. If they can't do that, they don't have a business. This is a fundamental disruption to the old way of thinking. The big brands spent billions of dollars on advertising to convince you that bundling is always simpler and cheaper. They created an entire culture around the idea of a one-stop shop. But what they're really selling is the illusion of simplicity, an illusion that often costs you thousands of dollars and leaves you with dangerous gaps in your coverage. The broker bundle or the custom portfolio is the antidote. It's the realization that in a complex world, specialization almost always beats generalization. You wouldn't go to a single doctor who claims to be an expert in brain surgery, cardiology, and pediatrics. You'd go to a specialist for each. Why should protecting your largest financial assets be any different? So we have 2 powerful competing models. The captive bundle, built on the pillars of brand loyalty, simplicity, and the promise of a discount. And the broker bundle, built on the foundation of choice, customization, and expert advice. One is a closed system, the other is an open market. But knowing the difference between these 2 philosophies is only half the battle. Because inside both of these models, hidden within the pages of the policy documents themselves, are the traps, the loopholes, and the fine print that can turn either approach into a financial catastrophe. And the single most dangerous trap is something called the named peril. Imagine your home insurance policy is a bouncer at an exclusive nightclub. Standing at the door, he holds a very specific, very short list of names. If your disaster's name is on that list, fire, theft, windstorm, you're in. You get paid. But if your disaster's name is not on that list, like say a freak meteor shower, or damage from the weight of ice and snow, or a mysterious power surge that fries every appliance you own, the bouncer just shrugs. Sorry, you're not on the list. You're left standing on the curb, facing the bill all by yourself. That, in its simplest form, is a named peril policy. It covers only the specific causes of loss or perils that are explicitly named in the contract. If it's not written down, it's not covered. Period. This is the single most common way that incredibly cheap insurance policies are constructed. They don't lower the price by being more efficient. They lower the price by systematically removing coverage. They shrink the bouncer's list. Now you might be thinking, okay, but the big stuff is probably on there, right? Fire, hail, lightning. I'm covered for the basics. And you might be right. But the danger isn't in the obvious catastrophes. It's in the 1,000 ambiguous disasters that happen every single day in America. The opposite of the bouncer with a list is the bouncer with a different kind of list. This bouncer lets everyone into the club except for a few troublemakers he's been told to watch out for. This is called an open peril or all-risk policy. It's a profound fundamental difference in philosophy. An open peril policy covers you against everything and anything that could possibly damage your home, unless it is specifically listed as an exclusion. The burden of proof flips entirely. With a named peril policy, you have to prove your disaster is on the in list. With an open peril policy, the insurance company has to prove your disaster is on the out list. This seems infinitely better, and in most cases it is. But this is the insurance world, and there are no free lunches. The all-risk policy's power is determined by the length and language of its exclusion list. And that list always includes the big uninsurable calamities: floods, earthquakes, war, nuclear hazards, sinkholes. But it also includes insidious, subtle things like mold, rot, wear and tear, damage from pests, and foundation settling. The devil, as always, is in these details. So how does this connect to the great bundle debate? It's the hidden engine driving the entire price difference. When an insurance company offers you a shockingly low price to bundle your home and auto, one of the first places they cut corners is by giving you a bare-bones, named peril home insurance policy, often called an HO1 or HO2. They're betting on you being seduced by the low monthly payment, never once cracking open the 80-page policy document to check the bouncer's list. They know you'll see the word home insurance and assume it means you're protected. Let me tell you about a family from suburban Ohio. Let's call them the Jacksons. They were thrilled. They bundled their 2 cars and their lovely colonial home with a big national carrier and saved over $700 a year. They felt like they'd cracked the code. 6 months later, a winter storm brought heavy wet snow, a lot of it. The weight accumulated on their roof over several days. One morning they heard a sickening creak, and a section of their living room ceiling began to sag, then crack. Water started dripping through. A contractor confirmed their fears. The immense weight of the snow had structurally damaged the roof trusses. The repair bill was going to be $18,000. Mr. Jackson, confident in his savings, called his insurance company. He explained the situation. The agent was polite, took the details, and a claims adjuster was sent out. A week later, a letter arrived. It was a denial of claim. Mr. Jackson stared at it in disbelief. The reason? His bundled, low-cost HO2 policy specifically named windstorm and hail as covered perils. But it did not name weight of ice and snow. It simply wasn't on the bouncer's list. In that one moment, their $700 in annual savings evaporated, replaced by an $18,000 debt. They had paid for a policy that protected them from a tornado, but not from the silent, crushing weight of a common Ohio winter storm. Now let's look at their neighbors, the Changs. The Changs went with a different strategy. They used an independent agent who advised against the cheapest bundle. Instead, he placed their auto insurance with one company and their home insurance with another, a carrier that specialized in more comprehensive coverage. They paid about $600 more per year than the Jacksons. Their friends thought they were being foolish. But their agent had secured them an HO5 policy, the gold standard of open peril coverage. When the same snowstorm hit, the Changs also noticed some minor ceiling discoloration. Their contractor found a similar, though less severe, issue. The weight of the snow had caused an ice dam to form on the roof, forcing water up under the shingles and into the attic. The total repair cost was $9,000. Mrs. Chung called her agent, nervous. The adjuster came out. A week later, a check arrived. The full amount, minus their deductible. Because their policy was open peril, the damage was covered by default. It was the insurance company's job to find an exclusion that fit, and weight of ice and snow wasn't on the exclusion list. Their decision to pay a little more for a structurally different type of policy, for a bouncer who let everyone in, saved them from financial disaster. This is the game being played. The super low bundle price isn't a discount. It's a trade. You are trading coverage for cost. You are trading a broad shield for one filled with holes. hoping a disaster flies through a solid part and not an empty space. The marketing focuses on the bundle, the discount, the mascot, the jingle. But the reality of your protection is determined by two little words buried on page 37 of your policy: named peril versus open peril. One approach places the risk squarely on your shoulders, forcing you to hope that your specific calamity was one of the dozen or so the insurance company decided to list. The other approach places the burden on the company, forcing them to honor their contract, unless they can prove your disaster falls into a narrow list of exceptions. The difference between these two philosophies is the difference between security and a gamble. And many people who bundle are making that gamble without even knowing they've been dealt a hand. But this is only half the story. Because while the named peril trap is waiting for you on the home insurance side of the bundle, an even more subtle, and potentially more devastating, danger lurks on the auto insurance side. It's a danger that has nothing to do with perils, and everything to do with two sets of numbers that can decide the entire future of your financial life. Those two sets of numbers are your liability limits, and they represent the absolute maximum amount of money your insurance company will pay out if you are found at fault in an accident that injures another person or damages their property. Every driver in America is legally required to have liability insurance, but the amount they're required to have is where the danger begins. It's called the state minimum, and it's one of the biggest financial traps in the modern world. Think about it. When you're buying insurance, especially in a bundle, what's the goal? To save money, to get the lowest premium. So when the agent or the website asks you what limits you want, and you see an option labeled state minimum requirement, it sounds official. Sounds sufficient. It's the legal amount after all. Why would you pay for more than what the law requires? And so millions of Americans, in an effort to be responsible and save a few dollars a month, unknowingly place a ticking financial time bomb at the very center of their lives. To understand the sheer scale of this risk, let's leave the world of policy documents and meet a guy named David. David is the picture of middle-class success. He's in his late 40s, has a wife, 2 kids in high school, and a home in the suburbs he's been paying off for 15 years. He's a diligent saver, contributes to his 401k, and has a decent amount of equity built up in his house. He's a careful driver with a clean record. A few years ago, he switched insurance companies and bundled his home and auto policies. His agent was great, got him a fantastic discount, and to keep the monthly payment as low as possible, David opted for the state minimum liability coverage on his auto insurance. In his state, that was 25/50/25. What does that mean? It means his policy would cover up to $25,000 in bodily injury for a single person, a maximum of $50,000 for bodily injury for the entire accident, and up to $25,000 for property damage. To David, these numbers seemed abstract but substantial. $50,000 felt like a lot of money. He felt protected. He felt smart. The $20 a month he saved went right into his savings account. Then came a Tuesday afternoon in October. The kind of gray, drizzly day where the roads are slick and visibility is poor. David was driving home from work, thinking about the presentation he had to give the next day. His phone buzzed in the center console. A text from his wife. He glanced down for just a second, not even a full second, but in that moment the car in front of him, a brand new minivan, slammed on its brakes. David's foot hit his own brake pedal, but it was too late. The tires hydroplaned on the wet pavement, and he slammed into the back of the minivan. It wasn't a high-speed crash, but the impact was jarring. The immediate aftermath was a blur of airbags, shocked faces, and the arrival of police and an ambulance. The minivan had a mother and her teenage son inside. The son seemed okay, just shaken up, but the mother was complaining of severe neck and back pain. She was put on a backboard and taken to the hospital as a precaution. David, thankfully unhurt, exchanged information, gave his statement to the police, and his car was towed. He was cited for following too closely. He was at fault. He called his insurance company, started the claim, and assumed the process, while annoying, would be handled. He had insurance for a reason, right? The first bill came a week later. It was from the auto body shop. The minivan he hit was so new, with so many sensors and advanced safety features in the bumper and tailgate, that the cost to repair it was over $30,000. David's policy had $25,000 in property damage coverage. His insurance company paid the $25,000, and then he received a letter from the other driver's insurance company. It was a bill for the remaining $5,000. David was personally responsible for it. He was annoyed, but he figured he could pull it from his savings. It was a painful, unexpected expense but manageable. This, however, was just the opening act. The real nightmare was unfolding in the medical system. The mother's initial checkup revealed a herniated disc in her lower back, pressing on a nerve. The injury required surgery, followed by months of intensive physical therapy. The son, who initially seemed fine, began experiencing debilitating headaches and was diagnosed with a severe concussion that caused him to miss school and required appointments with a neurologist. The medical bills started as a trickle, then became a flood. Ambulance ride, $2,000. Emergency room visit with CT scans and MRIs, $15,000. The back surgery alone was $60,000. The follow-up care, physical therapy, and specialist visits added another $30,000. The son's neurological treatments and checkups cost $10,000. In total, the medical expenses for the mother and son soared past $115,000. David's insurance policy had bodily injury limits of $25.50, $25,000 per person, $50,000 total. His company promptly paid out the full $50,000, $25,000 towards the mother's bills, and $25,000 towards the son's. And then they were done. Their legal obligation was fulfilled. David was now on the hook for the remaining $65,000 in medical bills. But it didn't stop there. The mother was a freelance graphic designer and was unable to work for 6 months during her recovery. That was another $30,000 in lost wages. All told, David was now facing a deficit of over $100,000, including the $5,000 for the car, $100,000 that he was personally legally responsible for paying. His savings account was wiped out in an instant. It wasn't even close to enough. Soon, a much thicker envelope arrived in the mail. It was from a law firm. The family he hit was suing him for the outstanding balance, plus damages for pain and suffering. The total amount of the lawsuit was $300,000. Suddenly, the world David had built began to crumble. The lawyer for the other family, through a process called asset discovery, found out everything about him. They knew how much money he made. They knew how much was in his 401k. And most importantly, they knew he owned a home with over $200,000 in equity. That equity, that symbol of his family's security and years of hard work, was now the primary target to settle the lawsuit. He was facing the very real possibility of a court-ordered judgment against him. This would lead to a lien being placed on his home, meaning he couldn't sell or refinance it until the debt was paid. They could garnish his wages, taking a chunk of his paycheck every single week for years, maybe even decades. The life he had planned, sending his kids to college, retiring comfortably, was evaporating before his eyes. All because of a 1-second glance at his phone and a decision he made years ago to save $20 a month on his car insurance. The bundle he had purchased gave him a false sense of security. It protected his house from a fire, but it did nothing to protect his house from him. The greatest threat to his home wasn't a storm or a burglar. It was his own car. The agent who sold him the policy had failed to explain that in the modern world of 6-figure medical procedures and $50,000 cars, state minimum liability is little more than a piece of paper. Keeps you legal, but it doesn't keep you safe. David's story isn't an exaggeration. It happens in courtrooms across America every single day. People who think they're insured lose everything because they misunderstand where the real risk is. It's not in the collision coverage for your 10-year-old sedan. It's in the liability coverage that protects you from the infinite costs of someone else's life. So what could have saved David? What could he have done differently to protect his home, his savings, and his future from that single moment of distraction? The answer is shockingly simple and incredibly cheap. And it's a type of insurance that your agent might not have even mentioned, but it's the one thing that separates a minor inconvenience from total financial annihilation. It is the single most important piece of the entire insurance puzzle. It's called a personal liability umbrella policy, and it does exactly what the name implies. It's a giant, protective umbrella that opens up over both your home and auto policies, shielding you from the kind of financial storm that can wipe out everything you've ever worked for. Let's stop talking in metaphors and get right into the brutal reality. Imagine you're driving home from work. It's raining. The roads are slick. You glance down for just a second to change the radio station. In that split second, the car in front of you slams on its brakes. You react, but it's too late. You swerve to avoid hitting them, hydroplane, and cross the center line into oncoming traffic. The impact is catastrophic. You've just hit a minivan. Inside is a family of 4. The father, a 45-year-old surgeon, suffers career-ending injuries to his hands. The mother has a broken pelvis. One of the children has a severe concussion. The medical bills alone are staggering. Ambulances, life flight, multiple surgeries, months of physical therapy. But that's just the beginning. The surgeon, who was earning over $500,000 a year, can no longer operate. He sues you, not just for his medical bills but for his lost future earnings, for his pain and suffering, for the emotional distress caused to his family. The total lawsuit comes in at $2 million. Now let's look at your auto insurance policy. You were a responsible driver. You didn't skimp. You bought what you thought was good coverage. Your policy has a bodily injury liability limit of $250,000 per person and $500,000 per accident. That sounds like a lot of money, right? It's the kind of number that makes you feel safe. It's not enough. Not even close. Your insurance company writes a check for the policy maximum, $500,000. They've done their job. They've fulfilled their contract. But the court judgment against you is for $2 million. After your insurance pays out, you are still personally on the hook for $1.5 million. $1.5 million. Where does that money come from? Comes from you. First, they'll take your savings. Your checking account, your emergency fund, gone. Next, your investments. That stock portfolio you've been building for retirement? Gone. Then they'll force the sale of your assets. Your boat, your second car, and yes, your house. The equity you've spent years building up vanishes overnight to pay this debt. And if all of that still isn't enough to cover the $1.5 million, the court will issue a judgment to garnish your future wages. This means that for the next 10, 20, maybe 30 years, a significant portion of every single paycheck you earn will be automatically diverted to pay off this judgment. You will be working, but you won't be building a future. You'll be paying for a single mistake from your past for the rest of your professional life. This is what we mean by financial annihilation. It's not just losing what you have now, it's losing the ability to ever build wealth again. It's a life sentence of financial servitude. Now let's rewind the clock. Let's go back to that same exact accident, but with one crucial difference. 6 months earlier, your agent convinced you to add a $1 million umbrella policy to your bundle. You hesitated, but it was only about $25 a month, so you said yes. The accident happens. The $2 million lawsuit is filed. Your auto insurance once again pays out its maximum of $500,000. But now, instead of you facing a $1.5 million bill, your umbrella policy kicks in. It's an excess liability policy. It sits on top of your other policies and activates the moment they are exhausted. Your umbrella policy covers the next $1 million of the judgment. So instead of owing $1.5 million, you now owe $500,000. That's still a devastating amount of money, no question. But this is why most financial advisors recommend an umbrella policy that covers, at a minimum, your entire net worth. If you had a $2 million umbrella policy, you would have paid nothing out of pocket beyond your deductible. Your savings, your home, your future earnings, all of it would have been completely protected. The cost for that level of protection? Maybe a few $100s a year. Less than $1 a day to shield yourself from a multi-million-dollar catastrophe. And it's not just about car accidents. The umbrella covers liability from your homeowner's policy, too. Your dog gets out and bites a neighborhood kid, resulting in nerve damage and plastic surgery. A guest at your summer barbecue slips on a wet patio tile, suffers a traumatic brain injury, and can no longer work. You host a holiday party, a friend has a few glasses of wine, and on their way home they cause a fatal accident. In many states, you, the social host, can be held partially liable for millions in damages. These aren't lottery ticket level freak accidents. These are things that happen every single day in America, and an umbrella policy covers them. It even covers things you've probably never even considered, like libel and slander. Your teenager posts something horrible and false about a classmate online, and the family sues you for defamation. You leave a scathing and perhaps embellished one-star review for a local contractor, and he sues you for damaging his business. These are personal injury claims, and they are often covered under an umbrella policy when they wouldn't be covered anywhere else. So if this coverage is so powerful and so incredibly cheap for the protection it offers, why doesn't everyone have it? There are two main reasons. First, there's a huge misconception about who needs it. People hear $1 million policy and think it's only for millionaires. That is dangerously wrong. A lawsuit doesn't care what your net worth is today. It's based on the damages you caused. A jury can award a $2 million judgment against you whether you have $2 million in the bank or 200. The umbrella isn't just to protect the assets you have. It's to protect the future earnings you don't have yet. It's a shield for your entire financial life, present and future. The second reason is a little more cynical. For an insurance agent, the commission on a $300 a year umbrella policy is tiny. It's almost nothing compared to the commission on a $3,000 home and auto bundle. So some lazy or rushed agents just don't bother to explain it. They focus on the big-ticket items, get the sale, and move on, leaving their clients catastrophically exposed without them ever knowing it. Your insurance bundle isn't just about getting a discount. It's about building a complete fortress of protection around your life. Your auto and home policies are the walls of that fortress. They're strong and they'll stop most attacks. But the umbrella policy is the impenetrable roof. It protects you from the one catastrophic aerial assault that can bypass your walls and obliterate everything inside. Without it, your fortress is incomplete. You might feel safe, but you are one unlucky day away from total ruin. So the question you have to ask yourself isn't, can I afford an umbrella policy? The real question is, can I afford not to have one? But simply knowing you need it isn't enough. Because how you structure this policy, and how it connects to your underlying auto and home insurance, is critically important. If you set it up incorrectly, you could create a dangerous gap in your coverage, leaving you exposed even when you think you're protected. And that hidden gap is what we need to talk about next. This gap is officially known as a self-insured retention, but a better name for it is financial ruin. It's one of the most misunderstood and dangerous pitfalls in personal insurance, and it happens because of a simple, logical decision that millions of Americans make every single year. Let me tell you a story about a guy we'll call Mark. Mark is the kind of person we all know. He's responsible. He owns a nice home in the suburbs, has a wife and 2 kids, and a stable job. He drives a safe SUV. When he bought his house, he did the smart thing. He bundled his home and auto insurance with a well-known national carrier. He got a good rate and the agent was helpful. The agent even convinced him to add a $1 million personal umbrella policy, explaining that for a few $100s a year, it would protect his assets if he ever faced a major lawsuit. To get that umbrella, the insurance company required that his underlying auto insurance policy carry liability limits of at least $250,000 per person and $500,000 per accident. Mark said, "Sure, that makes sense," set it all up and put it on autopay. For years, he was perfectly protected. Then the renewal comes in the mail. His auto insurance premium went up by $30 a month. It's not the end of the world, but it's annoying. He sees commercials every single day promising to save him hundreds of dollars on car insurance. So he decides to shop around. He goes online, plugs his information into a few websites, and finds a policy from a different company that saves him $45 a month. That's over $500 a year. He thinks, this is a no-brainer. He still likes his homeowner's insurance company, and his umbrella policy is with them, so he decides to just move his auto insurance. He buys the new, cheaper auto policy online and cancels the old one. He's proud of himself for being a savvy consumer and saving money. But here's the fatal mistake he made. A mistake he didn't even know was possible. The new, cheaper auto policy he bought online only had liability limits of $100,000 per person and $300,000 per accident. He might not have even noticed. The website probably defaulted to a lower coverage to show him a more attractive price, and he just clicked next. He never thought to call his homeowners and umbrella insurance agent to tell them he'd switched his car insurance. Why would he? They were separate policies, right? 6 months later, Mark is driving home from work. He glances down at his phone for just a second to read a text message. In that split second, traffic ahead of him slams on the brakes. He looks up too late and plows into the back of a luxury sedan. The accident is severe, and it is 100% Mark's fault. The driver of the other car is a successful surgeon, who suffers a serious back injury that will require multiple surgeries and prevent him from working for over a year. The lawsuit arrives a few months later. The surgeon is suing Mark for $2 million to cover medical bills, extensive lost income, and pain and suffering. Mark is terrified, but then he remembers his insurance. He thinks, this is horrible, but this is why I pay for insurance. I have a $1 million umbrella policy. I'm covered. He calls his new auto insurance company. They investigate the claim and quickly agree to pay out their policy limit of $100,000 for the surgeon's bodily injury. That leaves a remaining $1.9 million in the lawsuit. So Mark calls the agent for his umbrella policy, the one with the $1 million limit. He explains the situation and tells them the auto insurer has paid its $100,000 limit. He expects them to step in and handle the rest, up to their $1 million limit. And that's when he gets the worst phone call of his life. The claims adjuster for the umbrella policy says, "Mr. Smith, I'm afraid we have a problem. Your umbrella policy was written with the requirement that you maintain an underlying auto liability limit of $250,000. Your new auto policy only has a limit of $100,000. Our policy is designed to kick in after the first $250,000 has been paid. Since your auto policy only paid $100,000, there is a $150,000 gap. You are personally responsible for that $150,000. Once you have paid that amount out of your own pocket, then your umbrella coverage will begin." Mark is in shock. He's on the hook for $150,000. That's more than his entire life savings. He saved $500 a year on his premium, only to create a $150,000 hole in his financial safety net. This is the self-insured retention. It's the gap between what your umbrella policy expects you to have in underlying coverage and what you actually have. When you unbundle your policies, the communication link is broken. Your umbrella insurer has no idea you've lowered your auto insurance limits with another company. They assume you are holding up your end of the contract, which is to maintain those required minimums. The contract you signed for that umbrella policy explicitly states those underlying limits must be in place. By switching to a cheaper policy with lower limits, Mark technically breached that contract. The insurance company isn't being malicious. They are simply enforcing the terms of the agreement. Their calculations, their pricing, their risk, was all based on them only ever having to pay for claims that exceeded $250,000. They never agreed to cover claims between $100,000 and $250,000. This is the hidden danger of decoupling your policies without professional guidance. A good agent who manages all of your policies, your bundle, would never let this happen. If you called that agent and said, "I want to lower my auto limits to save money," they would immediately warn you, "You can't do that, because it will violate the terms of your umbrella policy and create a massive coverage gap. It's not worth the savings." But when you act as your own agent buying policies a la carte online, no one is there to raise that red flag. Mark's story ends badly. He had to take out a second mortgage on his home to pay the $150,000 gap. His wages were garnished. The financial stress nearly destroyed his marriage. And all of it was completely avoidable. This isn't just about umbrella policies either. This principle of mismatched coverages can appear in other, more subtle ways. You might have a specific exclusion on one policy that you assume is covered by another. You might have different definitions of residence or covered property between your home and auto policies that only become apparent after a disaster, like a fire that destroys both your house and your car in the garage. When one company handles everything, they use a standardized set of definitions and terms across the board. Their home policy is designed to fit perfectly with their auto policy and their umbrella policy. They're interlocking pieces of a single suit of armor. When you start swapping out pieces of that armor for cheaper parts made by someone else, you can't be sure they'll fit together. You might save a little weight, a little money, but you're creating gaps in your protection. And you'll only discover where those gaps are during the battle, when it's far too late. So the critical lesson is this: an insurance bundle isn't just a marketing discount. It is a cohesive, integrated protection strategy. Breaking that bundle can, and often does, have consequences far beyond losing a multi-policy discount. It can create catastrophic gaps that you won't see until you're falling through them. The question now becomes, how do you prevent this? How can you look at your own policies right now and be absolutely certain a gap like this doesn't exist for you? And if you do want to shop around, what is the 100% correct way to do it without putting your family's future at risk? The answer is to stop thinking like a consumer and start thinking like a CEO. The CEO of your own life, of your family's financial future. And the first thing any good CEO does is conduct an audit, not of the company's finances, but of its defenses. You need to conduct a personal insurance audit, and you need to do it this week. It's simpler than it sounds. First, you need to find your policies. Not the app on your phone, not the little card in your glove box. You need the actual policy declarations pages. If you can't find them, call or email your agent or company right now and say, "Please send me the declarations pages for all my current policies." They have to give them to you. This is your starting point. It's the blueprint of your financial fortress. Once you have them, you're not going to read the whole thing. You're going to look for 3 specific numbers that tell you 90% of the story. On your auto policy, find your bodily injury liability limits. They'll look something like 50,000/100,000 or 100/300. This is the amount your insurance company will pay if you injure someone in an accident. The first number is the max per person. The second is the max per accident. State minimums are a joke. They're a financial death sentence. If you have anything less than 250,000/500,000, you are playing with fire. This isn't about protecting your car. It's about protecting your house, your savings, your future wages from being garnished for the rest of your life because you caused an accident that exceeded your tiny policy limits. Next, right next to it, find your uninsured and underinsured motorist coverage. This is the single most important coverage you have for your own family. This protects you when someone else hits you and they either have no insurance or they have the state minimum garbage. This pays for your medical bills, your lost wages, your pain and suffering. The golden rule? This number should always match your own liability limits. If you're willing to protect a stranger with a $250,500 policy, why on earth would you protect your own family with anything less? It's often a difference of just a few dollars a month for a massive increase in protection. Check that number. If it's lower than your liability, you have a major gap. Now grab your home insurance declarations page. Find the line that says, coverage a dwelling. This is the big one. This is the amount the insurance company will pay to rebuild your house from the ground up if it burns down. And here is the most dangerous misconception in all of personal finance. This number has nothing to do with your home's market value. It has nothing to do with what you paid for it or what Zillow says it's worth. That includes the value of the land. You can't insure land against a fire. This number must equal the current cost to rebuild your home, the lumber, the labor, the permits, the everything. With construction costs soaring, most American homes are now dangerously underinsured. If your home is insured for $300,000 but it costs $450,000 to rebuild today, that $150,000 gap comes out of your pocket. It's the difference between rebuilding your life and facing foreclosure on a pile of ashes. So how do you know if it's right? A good agent will use a sophisticated replacement cost estimator. You can get a rough idea yourself by multiplying the square footage of your home by the average cost per square foot to build in your area. You can find these figures online by searching for average home construction cost per square foot in your city. If that number is significantly higher than your coverage A, you have an emergency. Now for the second question. How do you shop correctly? You do it by destroying the myth of the apples to apples quote. This is the trap everyone falls into. They take their current, likely inadequate declarations page and send it to 5 companies asking for a cheaper price on the exact same coverages. That's like taking a leaky lifeboat and asking people to bid on patching it, instead of just buying a new boat. The goal is not to get the same coverage for less money. The goal is to get the best possible coverage for a price you can afford. You start with the coverage, then you find the price. So, when you call an agent, and I highly recommend calling an independent agent who can shop dozens of companies for you, your conversation is completely different. You don't say, "Can you beat this price?" You say, "I've audited my current policies and I believe I have some significant gaps. I need your help designing a protection plan for my family." You've just changed the entire dynamic. You're no longer a price shopper. You're a partner in protecting your assets. Then you ask specific, intelligent questions that show you've done your homework. Write these down. Question 1. For my auto policy, I want to see a quote with liability limits of $250,000/500/100. But I also want you to show me the price difference for $500,000/100,000/100. I want to see how much a truly significant level of protection actually costs. Question 2. On the home insurance, my current dwelling coverage is X. Based on the details of my home and my zip code, what does your replacement cost estimator say my home should be insured for? I'm more concerned with being accurate than being cheap. Question 3. Can you please explain the difference between replacement cost and actual cash value for my roof and my personal property? I want to ensure I have full replacement cost on everything. This is critical. Actual cash value means they pay you for what your 10-year-old roof or 5-year-old TV is worth today, which is basically nothing. Replacement cost means they pay for a brand new one. Question 4. What is my water backup and sump pump overflow limit? I have a finished basement, And I need to know if $25,000 is truly enough to replace the flooring, drywall, furniture, and have professional remediation done. The answer is almost always no. And here is the final, most powerful piece of the puzzle. The one thing that ties it all together and seals the cracks we've been talking about. After you've established your base home and auto policies with high liability limits, you ask the million-dollar question. Literally, you ask, how much would it cost to add a $1 million personal umbrella policy on top of all this? An umbrella policy is the single greatest bargain in the insurance world. It is a separate policy that sits on top of your home and auto liability limits. If you have a $500,000 liability limit on your auto insurance, but you cause an accident that results in $1 million judgment against you, your auto policy pays the first $500,000, and your umbrella policy pays the next $1 million. It's a giant, inexpensive shield that protects everything you own and everything you will ever earn. And the cost will shock you. For most people, a $1 million umbrella policy costs between $20 and $40 a month. That's it. For the price of a few lattes, you can add $1 million force field around your family's entire financial life. It is the ultimate gap filler. It is the final piece of the fortress. The bundle, you see, was never the point. We started this journey talking about a simple discount, a marketing tactic used to get you in the door. But the discount itself is meaningless if the protection it's attached to is full of holes. A 10% discount on a policy that leaves you exposed to a $500,000 lawsuit isn't a good deal. It's a catastrophe waiting to happen. The real value of the bundle isn't the money you save. It's the simplicity of having your fortress managed by one trusted advisor who understands the whole picture. It's ensuring your home, your auto, and your umbrella policy are all working together, with no gaps, to create a seamless wall of protection around your life. So I'm asking you to do something. Don't just watch this and forget it. This week, find your declarations pages. Look at those 3 key numbers: auto liability, uninsured motorist, and dwelling coverage. See where you stand, and then make one phone call to an independent agent. Ask them the questions you learned today. Ask them to be your partner to help you build a real plan, not just sell you a cheap policy. Ask them for the umbrella. Because the difference between a home and auto bundle that saves you $100 a year and one that saves your family from financial ruin is knowledge. It's the knowledge you now have. Use it.